So, Neil, do you mean to say that fixed rate mortgages are coming down, and yet we don't hear any of that on the news at all? Tell me more.
Apparently that's true, Jim. Even more, a couple of more emails today from a couple of lenders.
So why is this then? I mean, the last few weeks have been utter chaos, and I thought you thought you should drop my line, and you did. So do you want to go into what it was all about in the background, about how these rates seem to be coming down?
Yeah, not at all, not a problem at all. As you say, utter madness the last few weeks.
Yeah.
In some ways, the most difficult times to be a mortgage broker since the credit crunch.
Mm-hmm.
I think the one main advantage that we have got at the moment is that banks do want to lend money, unlike during the credit crunch. So we're not that bad. But in terms of keeping up with rates and everything, it's just been a nightmare.
What do you think caused this then? What do you think caused all this? What do you think caused this huge spike and then everybody withdrawn their deals from the market? Because we got that in the news, but we don't seem to be getting what you're saying on the news.
Yeah, well, it was caused by Luz Truss, quite frankly.
Okay.
Obviously, we've been going for the last year. Well, since December, we've started to see rates rise. Because of inflation, because of the price of fuel, cost of living, and all that kind of stuff. All outside factors that the government don't necessarily have a lot of control over.
Mm-hmm.
Obviously, the Bank of England's main tool to combat inflation is to increase the Bank of England base rate, but that doesn't necessarily have a knock-on effect to what people are paying on a fixed-rate mortgage, because the money comes from
what's the base rate right now then?
2.25.
Okay, that's just for historical purposes, in case anybody's watching this later on. So base rate at 2.25,
which is actually very low in a historical sense as well. But we've been at 0.1% for quite a while because of COVID. So it has been a shock to the system for a lot of people.
Yeah, and it was quite interesting because you said to me that the fixed rate mortgages market isn't linked to the base rate. That's actually quite a revealing thing for me. I didn't realize that at all. I thought as soon as, I thought that actually had a bearing on it completely. So, tell me more about that.
Yeah.
I mean,
there's not a direct link like there is with variable rates. So I'm not an economist, so I'll talk to you in sort of the way I understand it myself. But the way banks fund fixed rate mortgages is that they buy in tranches of capital from outside at agreed rates that they then lend to their mortgage customers.
So is that called the swap rates?
Yes.
Is that what that is? Yeah.
It's the swap rates that you hear about on the news, and they're impacted by things like, obviously, financial markets, the value of the pound and all that kind of stuff, which we'll come on to later on.
And probably genuine sentiment. So just like if I was to put a proposition to someone and they said, go and invest in my business, I would then assess how much risk I think investing in their business would actually cost me, or what it would take for me to get a good return for the risk I'm taking. Is that how swap rates work?
They kind of base it on that, although that more comes into the fact if you're lending a 90% mortgage, you're going to charge a higher rate than you would at 75. So that's how they price that. But but when the Bank of England puts up interest rates, that doesn't directly affect the price of a fixed rate, but what does impact it is then supply and demand and how much money you've got and the cost of buying that in from the swap rates, as we said. So the other key to all of this over the last 6 months in particular has been about service levels. So if you are in a time when interest rates are going up, more and more people want to move from variable rates to a fixed rate and lock in their rate for the foreseeable future. So you've got a supply and demand issue. So first of all, the amount of capital there to lend at that price will run out more quickly. So you have to go back to swap rates, buying it more. If it's a higher price, you then have to pass that on. The other thing is, though, that while mortgage lenders are taking in applications, they want to be able to process them and lend to the customer as quickly as possible, get the mortgages approved so they can move into the houses or build their extension. And if you get an influx of applications because you are the cheapest mortgage lender, eventually you're going to get to the point that you can't cope. And that's one of the things that's been happening over this year is certain lenders, a lot of lenders have at times really suffered with their service levels because of the influx of applications.
Yeah.
One of the biggest lenders in the country, who on average during my 19-year career would normally take about 5 days to assess an application once you've submitted it.
Yeah.
They're currently working on a 20 working day turnaround before they even look at a new application.
That's effectively 4 weeks.
Yeah. And then the only way to turn that tap off is to pull your products, increase your interest rates, so somebody else then becomes to the top of the pile and is the cheapest, and then they start receiving all the applications. And you get this increasing cycle, which is what, until recently, has driven up fixed rate mortgages more quickly than variable rates that have been linked to the base rate. Because the base rate, while it's increased, hasn't actually gone up by a huge amount.
Okay.
It's gone up by just over 2%.
I assume as well the base rate actually increasing will have a bearing on the fact that the people actually investing in the swap rate will then go, maybe I should actually just be putting it in something else because I might get a higher return.
I'm not sure that's necessarily the case, but I think it would be that because there is more need for more fixed rate mortgages, that will put up the price of fixed rates as well. Plus, as I say, there are other market factors. The economies in general have been slowing down and that kind of thing around the world because of inflation and high fuel costs and that kind of thing. So that probably drives that a bit more than them just sort of speculating on being able to potentially charge higher product rates, I would have thought.
Perfect. Okay, if anybody's got a question out there, please feel free to ask. Neil is available to answer your questions live on the show. If you're watching it on the catch-up or the rerun or the podcast, then by all means, put the question in the box anyway, and we'll catch up with it later on. So then comes Liz Truss and her disaster plan, which really sent the financial markets into a tailspin, didn't they?
They did, because it was basically increasing spending with while cutting taxes without getting it costed by the other departments.
The OBS, the Office of Budget Responsibility, basically never costed it and never saw anything at all. So it's probably complete naivety on their part. Yeah,
and that caused the value of the pound to crash. It caused government bond values to crash and all that kind of thing. And these, as I've already said, have a direct bearing on swap rates, the value of which the price of which went up hugely overnight. Lenders, there was so much uncertainty that a lot of lenders started to panic because they didn't know what a swap rate was going to be tomorrow, let alone in a week's time. So what should they be charging on interest rates and all this kind of thing?
So if in doubt, just pull out. That's it, really, in essence, and just get all of it out right now. But that's the first thing to get reported on the news. But what the news have failed to report is actually a lot of these lenders are coming back into the market and have come back in.
Yeah, so the reasons for that as well. So yeah, I mean, just to a wee bit more about the chaos briefly, Jim, as obviously a lot of lenders, Halifax kind of stuck with the first one to make changes in that they withdrew products with fees because you can pay an arrangement fee to buy a lower rate. They did away with that. They just wanted to charge a rate. That's it. Other lenders then reduced their products, and some came out of the market completely, particularly in the buy-to-let sector and other specialist lenders like of that type.
Yeah.
And then rates were constantly being withdrawn with absolutely no notice. And when you're trying to secure an interest rate for a client, it's a nightmare because you quote a rate one night, it's gone the next morning.
Yeah.
And as I said to you in the email, there were times that I'm sure I wasn't the only one. My colleagues would have been doing it up and down the country, probably. I was sat here at 10:30, 11 o'clock at night trying to key an application because you just don't know that the rate's going to be there the next morning.
Yeah.
And I keyed 3 applications in one day where every single one of those clients, I was on the third mortgage lender because the rates that we previously discussed just kept disappearing.
Yeah.
So it was very, very difficult. That then also obviously causes clients to panic and try and rush through applications, which then puts more strain on the mortgage lenders, which means more rates get pulled because, again, nobody wants to be the cheapest. Then, obviously, she resigned.
Yeah.
And automatically that initially started to stabilize things slightly. The financial markets, certainly the value of the pound went up slightly. I think bond rates improved a little bit. Swap rates calmed down. Lenders started to calm down in that they weren't pulling rates as quickly as they had been. And then obviously, as you mentioned just a couple of minutes ago, we've actually now seen in the last week lenders returning to market that hadn't been there for the last 2 or 3 weeks. And in this week in particular, since Monday, we've seen a good handful or more now of mainstream lenders, some of the big high street names, actually reducing rates as well as offering more rates. So there are more products available than there were, lower rates than there were a week ago. One of the buy-to-let lenders has reduced its rental stress test calculation, which has been a big impact on the buy-to-let sector.
They would have to, because in Scotland, obviously, the difficulty is where rent freezes are going on just now. If anybody wants to remortgage, it might cause them a huge problem because base rates are going up. And that's obviously influencing a variable rate or a rate that they'll get on, and the stress test might actually not cover it anymore. So, it's actually good news for the Scottish market, especially in terms of the buy-to-lets. So, medium to long-term outlook may not be as bad as actually what the doom and gloom merchants are saying, is it?
Well, I was watching the news last night, and they were actually starting to say that about the economy as a whole. Which is obviously good. And we're not, as a mortgage advisor, clients say, what's going to happen with interest rates in 2-3 years' time? We're actually strictly not allowed to speculate on what's going to happen with rates.
Well, we can do is advise them this morning. But I don't know if you've seen the news right now that Lloyd's are actually predicting that next year house prices will actually drop by 8%.
Hadn't actually seen that, no.
It's just gone on there now. So house prices are supposed to drop by 8% next year. I already forecasted it 4 and 8% anyway. So I was telling clients privately that's kind of where they're going to go. But really, that won't do anything. Really, that only put us back to last year, because in the last 12 months, Fife house prices, for example, have gone up 8.8%. So even if they dropped 8%, we're only back where the year before was. So it's not really that much of a problem, because most people stay in their home for 7 years and beyond, ultimately. So, that'll all recover over time, I would imagine. So I don't think that will have a huge impact on the market, will it?
Not really. And, well, I say that, hopefully not. I mean, obviously, there was talk of, the other thing there was talk about potential falls because of a result of COVID and high unemployment, that kind of thing, and that never happened. So we just have to wait and see on that front. But like you say, when those percentage figures aren't going to be any worse than we were a year or two ago before these steep climbs.
Then when I think about it just now, people are actually generally on average in the Fife area, or the Northeast Fife and the East Fife area of Fife, they're generally paying about 8 or 9% over the home report value. So if you thought about it in real terms, that means people next year will just be paying the home report value. So there won't actually be a reduction in house prices. Does that make sense?
It does, and if that is the case, then it would be very beneficial, because obviously it makes our life a lot easier for people with slightly smaller deposits. If they're able, a 90% mortgage is a true 90% mortgage of what they're actually paying.
So I think home reports have actually possibly might end up saving the day, because it makes complete logic. It makes absolute sense in terms of where the market is just now and where it will be in a year's time. And if that's what people are paying over the home report right now, in a year's time, that price will be reflected in there, but then it'll just drop back. So it'll drop back to today's prices, not last year's prices, really, in essence, because they're all still to come through. We only know that because we know the pipeline, and we know what's getting over the asking price and what the average is in the Fife area. And it is generally around about 8% value. Some people will pay more, some people will pay less, but on average it's 8%. So if that did happen and all these went through, then we'll just be at home report value as it was next year, and the total overall impact won't be that much, if not negligible at all.
No,
which will stabilise the market quite well.
Yeah, definitely. I mean, obviously, in terms of rates, we have seen these reductions. I was looking at some figures a wee while ago, and 2 weeks ago, you could barely find a rate under 6%. across anywhere. Whereas I just looked at some examples for you. So on a 90% mortgage, 2-year fixed rate, you're looking at my cheapest deal I could find was 5.94 with a 999 fee, or 6.14 with no fee. On a 5-year fixed, you're looking at 5.49 with a 999 fee, or 5.69 with no fee.
That's interesting. That means they actually think base rates are going to drop then, or over the 5-year period, as opposed to the shorter term, which is a bit higher. Because generally, yourself, it's the 5-year is usually a lot more than the 2-year. But it seems to be the other way around. So the market must be predicting that base rates might go up, but potentially they'll probably come down in the medium to long term.
Yeah, hopefully that's the case. That it does appear that with that pricing, that the markets expect some of these issues to hopefully be fairly short term.
Yeah.
But obviously it's good news in the meantime for people looking to arrange their mortgage now, because we're at a point they have come down a bit. I've looked at 75%, and they're all now, regardless of whether it's a 2, 3 or 5 year, they're all below 6%, which wasn't the case a week ago.
Yeah. So a question from one of the people actually watching this, they've said, it says, is it any easier to get a mortgage now than it was 6 months ago, or is it harder, or is it just the same?
It depends how you quantify that question.
Yeah, but what's your? I kind of think. Well, for example, if somebody was going for a £200,000 mortgage and it was a 90% loan to value, and it was 6 months ago, would it have been easier to get 6 months ago than it would have been now, or would it kind of just be the same anyway, or just a little bit harder or a little bit less?
In terms of general criteria,
yeah,
I don't think a hell of a lot has actually changed. Lenders still lending pretty much in the same way. They're calculating somebody's income in the same way. They're possibly actually slightly easier for self-employed than it was, because we're a bit further away from the big lockdown, and people have had now maybe got 2 years accounts behind them since that, since furlough and all that kind of stuff. In terms of overall affordability, that has obviously been impacted because it is linked to interest rates. So the higher the interest rate, the higher the monthly payment, the less your affordability becomes.
Are lenders still stress testing, even though they don't need to anymore?
Pretty much, from what I'm seeing, yeah.
Yeah, I kind of thought they would keep that on, even though they said that they didn't need to do it anymore.
I mean, even
to make sure their liquidity is right.
Partly because of that, but also even when you're talking about the fact that you're comparing a rate from 1.6% a year ago, you're now looking at 5%, 6%. So it's basically stress tested itself. Even if you're basing it on the current rate, that's putting a lot of stress on that income calculation. So
right, that makes sense, because so then everybody that was stress tested maybe 2 or 3 years ago was actually stress tested at this rate anyway. So
not to this extent. So
when you think about the logic over that, then that means most people are in a more stable position than they would have been if it was 2008.
Oh yeah, in 2008 they just looked at the here and now.
Yeah,
and didn't even verify income in a lot of cases.
So it's all quite positive signs then, and some stability is actually beginning to equalise into the market. Obviously, inflation is going to be high just now. They are still driving this agenda, on the news. They don't want to talk about the headline rate being 10%. They just want to talk about food being 17%. But if food's 17% out of that 10% on average, then obviously something else has got to be maybe 5 or 6%. But they don't want to talk about that, because obviously that isn't newsworthy. Do you think there's a hidden agenda out there, and they just want to peddle the doom and gloom thing?
Well, that's what the news tends to do anyway. So, but at the end of the day, newspapers and news channels, their job is to get viewers or get subscribers and sell themselves, and bad headlines tend to do that more than good.
Yeah. So if anybody needs to speak to you, then You know, what can they do? How can they get in touch with you? Now, I've put your contact mobile on here, I've put your email address on here, and I've put your Facebook page on here as well. So if anybody else, you know, what's the easiest method to get in touch with you?
Any of those. I mean, my mobile is on all the time,
Yeah.
and voicemail is always there. So if I don't answer, I will always come back to somebody. Email, obviously, reply to that whenever. And the Facebook, it's my business page, I think, that you'll have put on there. So again, can always respond to messages there as well.
Any final words before we finish off?
Obviously, we are looking at an interest rate rise next month. So probably next week.
Predictions. What do you think it'll be, and why?
This is purely guesswork on my part, but I'm going to say 0.75.
Wow.
Because
okay.
There had been talk about a 1% rise.
Mm-hmm.
And some of the things, look, apparently the cost of fuel's come down slightly.
Yeah.
Cost of energy has actually apparently fallen. The outlook for the economy, well, the pound's gone up. So there are more positive signs than there were. So I'll expect there to be a fairly significant increase because inflation is so high, maybe not as high as they were predicting before.
I have a sneaking suspicion it's 0.25. And,
okay.
and I know that's the opposite end of the spectrum. I do believe that the ship's already sailed and the momentum has built already. So the downward slide into what they called, because they were all saying recession's coming, recession's coming, recession's coming. So clearly they must have indicators from before that the recession's coming. So, you know yourself economics. By the time you've actually put something in place to try and fix the problem, you'll only get the effect 6 months down the line. You know how it works. And I feel that 0.25 would be more appropriate just to make sure, especially as we're going to winter and especially as we're going to a time where people probably need more money in their pocket than anything before. That's kind of why I'm thinking 0.25 are now until they assess maybe to get the next mini budget on the 17th of November, until we get the next mini budget in. And I do think that might give some stability to the whole market anyway. So things might stabilise quite well. And I think possibly maybe to December and into January, that's when they might think about another 1/4 point rise. But I don't think it's actually going to be as severe as we think. But who knows?
Who knows? We'll see in a week or so. In fact, it should be a week today, first Thursday in the month. I'm hopeful that the lenders have maybe already priced this into their current fixed rates.
Yeah.
Because what would be the point of bringing them down this week to only put them up again next week when they get the rate rise that we're all expecting anyway? So
I've got a funny feeling they get told way before this. I have a sneaking suspicion. Well, look at Halifax. They made a mistake and they sent an email out to everybody, and I got it as well saying about the rate rise, and it hadn't been announced yet.
Yeah,
and I think I got that as well. Only a couple of months ago. So when you think about it, somebody somewhere knows this is probably going to come in at a certain figure, and they've also done their due diligence. There's only a formality to turn up to the meeting and say, by the way, I'm going to vote against or for or whatever. So I kind of think that this has already been done, and it's only a formality waiting for it to happen. And I think you're right. It's probably been factored in already into the markets already. Hopefully that's the case. Stability will prevail, and that's it. Thanks very much for coming on the show and giving your mortgage market update. If you liked it, guys, hit that big thumbs up and give us a comment as well if you want it, because we could maybe bring this back every single month for you. Until next time, it's bye-bye from us.
Thank you. Bye.